The information shared during this conference call is provided for educational purposes only and should not be considered an offer of services by Ellevest. This call is being recorded. It's now my pleasure to welcome everyone to today's conversation. My name is Sara Faurer. I'm a wealth advisor on the Ellevest team, and I'm joined by Vice President of Investments, Ankur Patel. Hi, Ankur.
Hi, Sarah. How's it going?
Good, good. How are you?
Doing well. Doing well. We got a nice day finally. Hopefully, this spring weather lasts longer and we don't get hit with 90 degrees too fast over here
Yeah,
on the East Coast.
a good kickoff to May. Happy belated Mother's Day to everyone out there. Good luck getting through the rest of the school year to all the parents out there. May's a crazy time.
Oh yeah, lots going on. Lots
Yeah.
going on.
In the markets as well, which I know we've got a lot to talk about today. So should we just dive right in?
Let's do it.
Obviously, had some headline news come out today. Inflation numbers went up in April. Um, Despite the Iran conflict that continues to go on, are we in it? Are we not in it? Elevated oil prices, continued geopolitical uncertainty across the board. Markets have rallied to new heights over the last month. So help us understand what's driving the disconnect between headlines and market performance, and how sustainable is it?
Yeah, I feel like the headlines have now caught up with the market, so it doesn't feel as disconnected as it once did, I'd say a week or two ago, but it's still in this um, phase where things like announcements about the war and the fact that there might not be a ceasefire soon.
Mm.
I think that was the latest that we got, and you can kind of can continue to see the market go up, and that can be a little concerning. But there are multiple reasons, as always, with financial markets in terms of what's driving them. So we'll get into it. I think in terms of sustainability, that is the big question. I think right now, what we're seeing is a mix of, you know, inflation risk, a mix of positive earning surprises that are driving stocks, a mix of optimism around AI. So a whole sort of consortium of things that are driving the market at this time. And I think, one thing, we like to do at the start of these calls is typically just walk through what have markets performed like this year so far, and that can help us sort of set the stage, I think. So let me pull up our data points and slides for today. And as you'll see here, this sort of year-to-date look at financial markets is very positive, very green across the board. This looked very different, I'd say 2 weeks ago. Um, we were looking at markets that were down or flat for the most part. Commodities has been up due to the war, due to oil prices. But when you look at stock markets here in the US with the S&P 500, or you looked at international markets like the EFA or EM, these were much lower, if not down, a little over 2 weeks ago. They have since rebounded very strongly. That is part of why people are asking, I think, right now, sort of what's driving this. Why did markets recover so quickly when the war hasn't sort of completed? Um, you look at fixed income now, it's flat. This was up a couple of points. I think interest rates have gone up because of inflation risk. I think today we got a higher than expected inflation print, so you've seen markets sell off a little bit. But the good thing is, we've had a pretty strong rally over the last couple of weeks. And if we look at sort of that point at which that happened, you'll see oil prices here that are in this lightly shaded green line spike aggressively above $100. We're still there in terms of a really high price point for oil, and the market sort of sold off close to 10% and then rebounded strongly, and now we're up over. We went past that previous high and we are up north of 8% on the S&P 500 right now, year to date. Um, a lot of this basically leads to questions around higher inflation and the potential for slower growth. We did have GDP north of 2% for the first quarter, so the economy is still growing, just very slowly. I'd say coming off of the fourth quarter, which was relatively flat, you're not seeing super strong growth from the economy, but it's not falling off a cliff either. And so the risk right now is if we have this slower growing economy, can it withstand this higher inflation? A lot of this is driven by that higher oil price right here. The CPI number is the headline inflation number. If you strip out the energy from that headline inflation number, it is a little bit under 3%. But you'll see typically, historically, these two are very correlated. So higher energy prices typically lead to higher prices for all goods. And the concern is if this stays elevated for longer, do we have a repeat of what happened post-pandemic, which was obviously a very, very difficult period for consumers to withstand, and they're not happy about it. You see high gas prices here, close to 450 on a national average, which is much higher than we've faced more recently. You see inflation expectations that now are getting close to 5% when you look forward over the next years, and you see consumer sentiment. So how consumers feeling about this type of environment is very, very sour at the moment.
Yeah.
So you have this conflicting picture where you have slower growth in the economy, um, you have higher inflation expectations, people are upset that prices are still high, yet you have a stock market that keeps going up. And so you have two very, different conflating pictures. I think one of the main drivers for stocks has been earnings because we have
Mhm.
gone through this latest earnings season, and I know we'll dive in more, but that's to me the question about sustainability lies sort of within that picture of earnings. So there is some positive things that are happening that are driving stocks right now, and it's not just, hey, there's hope that this war is going to be over sooner rather than later.
Yeah. When you lay out the juxtaposing data, I think it's fair that investors are confused, right? It's hard to put into context high stock prices with all of the other information that is coming out about, inflation and growth and the conflict. So let's stay on oil for another question. We're seeing this really sizable oil shock. Um, Not quite the same though when we think about, previous oil shocks that we typically put into context, like the 1970 style crisis, echoes of stagflation. What is structurally different about today's energy landscape? How should investors be thinking about inflation and growth implications? And maybe part two of the question is, can we expect the price of oil to come down quickly once the conflict is over? If anyone's looking to buy flights for the end of the year,
Yeah.
how
Oh,
fast does
that
that
is
trickle through the market?
Please, it has been a painful exercise planning anything for
Yeah.
the rest of the year. So, uh, I think for all our sakes, I hope it's sooner rather than later. But unfortunately, it doesn't seem to be. I think, taking those 2 points in terms of what we've seen historically
Hmm.
and where we're at today, one of the biggest differences that I think, um, typically most people don't appreciate is the fact that we are not as dependent on foreign oil as we used to be. So the US itself, you can look at this chart and say, wow, like we have gone from a net sort of importer to a net exporter. We produce a lot more oil and export a lot more oil than we have in the past. And today we probably are the largest exporter or largest producer of oil. You can see here, this straight line up since 2010, we are producing way more than we have in the past. Um, and so that gives us a bit more cushion, I think, coming into this year and this war specifically. Um, the US and other countries around the world actually have been dealing with a bit of an oversupply in oil. And so that sort of set the stage for, yes, this was, the highest sort of supply shock that we've seen, where 13 to 14 million barrels are coming off the market every day. We haven't seen that in the past, but we were starting from a position of strength. There was more supply in global oil markets than had been previously. And again, the US produces more than they used to. So the issue that we used to face is not the same. Where if our foreign dependence was just as high, then this would be a lot tougher prices would be a lot higher, and it would be a lot more challenging for consumers. I think the reason that, this becomes a problem, and it was such a big problem in the 70s, if you look at unemployment, and this is the period we're talking about here, the 70s, the late 70s, early 80s, where you see these high unemployment numbers, close to, 8 to 10%. Um, the issue there is when you're battling inflation, you're typically using interest rates to do that as an economy. The central bank is raising interest rates to slow things down in order to tame inflation. Now, if you're stuck with high unemployment, and you're trying to slow the economy down, that's not going to help your
Mhm.
employment picture. So it creates a really big problem, and that's, the big risk with stagflation. Right now, if you look at where unemployment is at 4.3%, this is still, I'd say, historically low. We are still at very, very low levels of unemployment. And I think, over the last year, there were a lot of concerns because the economy hadn't been adding as many jobs every month. But the labor market stayed in balance because we had not seen the same level of net immigration to the US. And so there had been this sort of balance that was happening last year where unemployment, we weren't adding as many jobs, but we also didn't see this unemployment number tick up too high, which is typically what we see. So you have two sort of really big factors that I think make this a different point in time than what we've seen in the past.
Makes sense.
Yeah.
Let's switch gears slightly to stocks and specifically thinking about international versus US markets. We've seen international and emerging market equities continue the outperformance that we saw in 2025 through the start of this year, compared to the US market, even as higher oil and energy prices, typically pose a headwind for many of those economies. So, what's driving that relative outperformance right now? And do you think it signals a durable shift in the global market leader, when we think about the equity markets overall, or just a short-term rotation?
Yeah, that's a great question. On that first slide that we showed, international markets were doing really well along with US markets. Emerging markets were up more than double, right? You're looking at 20% plus already year to date. And that sort of mirrors what we saw last year, where international and emerging markets were outperforming the US. And so I break this down in a couple of different ways. And one is, last year the risk was, the all the changes in policy that are coming out of this administration, the tariffs, the sort of onshoring, all the things they were talking about led to a lower dollar. And you can see here that in this dark green line, the US dollar fell. It's had its biggest decline in over 30 years. And that was in the first half of last year. And so that explained a really, really big move in international markets in the first half of 2025. Then what you see is sort of the dollar kind of stabilizes from there on. And yet international markets continue to perform well and outperform the US. And so to me, the currency argument was there at the first half of last year, but really hasn't played a prominent role since then. And so one that to me, that's a vote of confidence that there's other factors at play that are driving those equity returns.
Hmm.
The next thing I'd look at is valuations. Here you can see, the argument for the longest time was, international markets, emerging markets are cheaper than the US, and therefore you should buy those markets. Obviously, that had not played out the way investors thought in the prior decade, but over the last, year plus, it has been working. And what you see here is levels that are, when you look at developed markets, this is sort of Europe and Japan, you're looking at sort of closer to long-term averages. When you look at emerging markets, you're looking still at below average levels in terms of valuation. So you don't want to just look at this and say international markets are cheaper than the US. That means they're good. You also want to look at how, cheap are they relative to history to get a sense of, is this still durable, or do all the gains that we've seen recently sort of eat up those that gap in valuation? And that doesn't seem to be the case, which is another factor that this could be more durable potentially. Um, you also can look at earnings growth. So I know there's a lot going on this chart here, but the long and short of it is these bars here represent earnings growth over the next 12 months, while these diamonds represent the valuation, that chart that we just looked at previously. And so you
Mhm.
can kind of say, oh, wow, like the US is growing. Their earnings per share looks like closer to 20%, while their valuations are up here over 20 times. And you look at the rest of the world and you can say, wow, emerging markets is trading here in the teens in terms of valuation, while their earnings growth is north of 30%
Yeah.
expected over the next 12 months. So there is some fundamental backing to this and for a whole host of reasons, but there does seem to be something to this change in leadership in terms of what's driving international markets last year and sort of this year so far.
Yeah, and the story last year obviously continues this year is diversification in portfolios, right? For so long, the US, without a doubt was outperforming the rest of the global market, and we've really seen the benefit of having exposure outside of the US market for equity portfolios. And we'll continue to do so.
Yeah, absolutely. I think there's also something to, you know, thinking through, we were talking a lot about oil prices and how that impacts inflation, but also how does that impact emerging markets?
Hmm.
There is a big component. There's a lot of, there's typically an argument made that when oil prices are higher, emerging markets will suffer. And because that higher cost of oil is very expensive, oil is traded in dollars. And typically that makes it more expensive for emerging market countries to purchase oil, to use oil, and to run their economies. Now, what doesn't get talked about as much is a lot of emerging markets are actually exporters. So, a lot of countries within this bucket of emerging markets produce oil and export oil and can take advantage of higher oil prices. So there's a balancing effect. So there's some countries that actually import more oil, like India, that it's going to be more expensive for. There's some countries like Brazil, or the Middle East, where they produce more oil and they export more oil and they can take advantage of higher oil prices. So there's a bit of balancing effect there too.
Yeah, yeah. And on the higher oil prices, we had a question come in from the audience in terms of the timing of, with the oil prices going up, how quickly does that impact the consumer? What's the lag time to, things becoming more expensive because oil prices are up and it hitting the consumer's pocket? Can you help us think through that timeline?
Yeah, I think it's pretty immediate, I would say. We've seen like the going back to the gas prices chart. I think that's the clearest picture in terms of when we see impacts of higher oil prices. This is going to be the first thing that changes. And you can see already this year it's gone straight up. That's going to be the first thing. I think the next order of effect is essentially how quickly does that higher gas price, higher oil price impact other goods and services, and that there is a bit of a lag there, but typically we're probably gonna see that over the next couple of months. It's not gonna take, sort of a year to play out. This is gonna happen sort of immediately. I think the bigger question that's related to that is also, when might we see a reprieve or when might oil prices come back down?
Hmm.
That's more challenging to figure out. I think the prevailing wisdom was if this war was going to be over by, I'd say now, the initial time frame of 4 to 6 weeks, then we had a chance of oil prices, gas prices by the end of the back half of this year, by the end of the year, coming back down. If it was going to stay elevated for longer, it was a big question mark, and the prevailing wisdom was gas prices could stay higher through the beginning of next year. Um, so even if there is an end, a full ceasefire, the Strait opens tomorrow, it's not, it seems like it's not something that, it's not like flipping on a light switch. The amount of supply that was lost is going to take time. All the containers and barrels that are sitting there are going to take time to get to where they're going. the amount of supply that's lost is going to take time to make up. So all of that to say that it's unfortunately not going to be something that we're going to see very quickly.
Yeah, probably much slower than we'd all
Yeah.
like to start seeing at the pump.
Yeah, absolutely.
So we're one full quarter into the year, which is kind of wild to think about, rapidly moving through a second. Companies, have been reporting, like you said, mostly very strong Q1 earnings over the past several weeks. So how should we be feeling about what those numbers are saying versus the volatility that we experienced, starting back in March? And when we think about portfolios, how should we be thinking about cash in this environment? Help us think about what it means for how we're invested.
Yeah, good question. I think maybe we take it in two parts, just sort of earnings picture first, then what do we do with cash? And I'd love to get your take on that too, Sarah. But starting with earnings, you'll see here the S&P 500 it is growing earnings at 15% over the last 12 months. This was probably the most unexpected thing coming into this year. Earnings had grown a lot over the past year or two, and the expectation was you see this bump in the road here, heading into this year, heading into tariffs, heading in uncertainty, heading into the potential for the war. All of that sort of created this picture that earnings were not just going to keep going up, and they did. And so no one really saw this coming, I would say. That's the first thing. A lot of this, it sounds like coming out of these earnings calls is driven by AI and productivity growth,
Mhm.
CapEx spending from the big sort of Mag 7 tech companies. And it's filtering through, it seems like, the rest of the economy. So you're seeing other sectors, not just tech, take it sort of a bump in earnings. The good thing about this, I think, is when you look at, similar picture that we looked at with the US rest of the relative to the rest of the world, when you look at just underlying sectors, you'll see that while tech here obviously is the fastest growing, this is more normal, I'd say. What's not more normal is seeing every other sector grow at like 10% plus. That's what we're seeing here. You're seeing industrials grow at 15%. You're seeing even financials grow at 10%. Um, a lot of this, especially with industrials, materials, even energy to a certain extent, is being driven by a lot of the CapEx that's coming out of the Mag 7, all these data center build outs, the reported sort of, I think it's $600 billion of spending from those seven companies this year. And that number is only growing over time. Where is it going? Right? It's not just going into other tech companies, it's going into a lot of the manufacturing that's needed to build this out. I saw Corning stock has exploded, which is traditionally a glass and dish maker, right? Because
Yep.
there's so much demand for glass and components that need to go into these build outs. And I think we're probably going to see more of that, like these companies, these one-off companies that you might not expect to be AI related are now becoming AI related. And that spending doesn't seem to be going away. I think the biggest fear last year was the fact that these seven companies were spending too much, that they weren't going to get a return on investment from AI because no one knew how it was going to pay off. And they started taking on debt, right? So it was sort of this picture of, okay, all this spend, but for what really? Are we going to get the earnings growth that we are? Now you're seeing things like Google, right? Which was supposed to lose market share because of everyone using ChatGPT and
Mhm.
LLMs and Claude and everything else now. Google reported earnings and Google's search business, Google's traditional search business is up over last year and has grown. And so it which doesn't make a lot of sense on the surface, right? Like I'm not using Google as much anymore, but I think it's, sort of a time when everything is growing and even these tools that we're using now that we weren't before are leveraging things like Google search, right? So you're seeing that. support that business. But um, to me, we're starting to see some of the things that were big risks last year and not come to fruition. And I think that one of the bigger examples of that too is just seeing Anthropic
Yeah.
this year and the massive growth they've seen. They were growing at 10 times um, a year prior to this year, and everyone kind of came into this year saying like, you're not going to 10x again. Even the CEO was on an interview saying the exponential growth in the actual technology is sort of reaching its peak levels where you're not going to see the same step level changes anymore. But in terms of usage, they've gone from 10x to this, I think this most recent quarter up close to 80x
Well.
and on a taking a massive leap in terms of just revenue. And, that's leading to questions about when are they going to IPO? We had already seen other companies like SpaceX talk about IPOing and combining with XAI. We've heard ChatGPT and sort of OpenAI talk about public IPO later this year. But if we start getting a string of IPOs in this space, that could also put more fuel to this fire. And so when it comes to thinking through the question of like cash, what do we do at this point in time? There are risks with the economy, obviously, and oil prices and inflation. But on the other hand, you have this sort of balancing set of risks, which are driving earnings. And
Mhm.
that seemed a lot less durable last year and a lot more durable this year because there's more proof points of sort of where those earnings are coming from and whether they'll continue. Now, you're not going to know whether they're going to continue at 80x growth, right? Like that seems unreasonable, but at the same time, no one thought like going beyond 10 times growth and beating that going forward was going to be possible. So it's sort of a bit of that, psychology of, you know, not understanding exponential growth that well, and it's really difficult to do, but it's sort of what we're dealing with right now.
Yeah, and when I think about putting cash to work or just more broadly, are you in the right type of investment portfolio in a time like this when the environment is hard to make sense of, when there's continued, a lot of uncertainty, more volatility in the market, yet earnings continue to go up. You don't want to miss the growth, but does it feel like the right time to get invested? All of that is, I think the time to go back to investing fundamentals, right? Do you have the right level of diversification in your portfolio? Do you have the right amount of risk versus stability with any fixed income that you have? Do you have your short-term cash shored up? Is the financial plan in place to navigate a time of uncertainty and also continue to invest in a disciplined way with a disciplined plan that you and your advisor have outlined, right? It kind of takes the emotion out of it when you're in a period of time that's really hard to make sense of. Because if you let the emotion guide you in that time, then you're either going to kind of be paralyzed by not wanting to make any decisions with your cash, or feel like, you're missing the right opportunities in the market. So bringing it back to the fundamentals of your financial plan and long-term investing, I think can help strip some of those emotions out and just continue to invest according to the plan.
Love that. No notes.
I think that is, let me just make sure we don't have any other questions that come in, but I think that's probably a good place to wrap for this month. We never know what's going to happen between now and next month's webinar, but we will be back, next month talking through it. So if there's any other questions that anyone has for their advisor team, reach out to us. We're always here to talk through everything.
Thanks, Sarah. Thanks everyone for joining.
Thanks,
Take
Ankur.
care.